Sizing your positions is one of the most important aspects of investing and trading. But do short sellers face the same concerns as long-only investors? Do they have to worry about position sizing too? In this episode, legendary short seller Jim Chanos, founder of Kynikos Associates, walks us through this key aspect of short selling. Every short seller has a specific niche, and Jim's expertise is all about position sizing, using a short portfolio to hedge out long investment risks. Jim refers to this as a sort of investment insurance, and he will explain to you just how he sizes his positions in his short portfolio. This is a unique opportunity to look inside the investment mind of one of the most successful short sellers in the industry, Jim Chanos.
There's sort of two ways to think about risk on the short side in the equity markets. One is to use basically discrete stop losses, in every position, and the other is to manage your positions on a percent of capital basis. We do the latter. In that I found that any stop losses that I've ever set on positions on the short side invariably get stopped. I don't like the market generally telling me what to do. I know that seems to be in violation of the way most traders think. If I thought that the market generally knew more than I did on my positions, I shouldn't be in them anyway. Understanding the volatility of each position and understanding where it fits in the broader portfolio, for us, it makes more sense to use a percent of portfolio approach. Now, no one position can ever be more than 5% in our portfolio. That's a hard and fast rule. But these days, they rarely get above 3 or 4. We tend to be pretty diversified. And if we love a position and it goes against us, as long as we still love the position, we'll trim it back. And of course, the corollary to that is that you have to be willing to add on the way down. If things are deteriorating and the news flow is going your way, you need to be able to sell a position maybe lower than where you covered some for risk management purposes. A great example of that was Valiant. We started shorted Valiant between $120 and $130 in 2014. We were covering stock at 180, 200, and 220, I think, within a year or a year and a half, and then selling it at 180, 160. I think we sold stock as low as 90 on the way back down. It's a matter of understanding positions get bigger when they go against you, obviously, on the short side, another asymmetry, and get smaller as they're working. So you have to understand that where they fit, and it's a dynamic approach. We probably spend as much time on sizing and understanding percent of capital, how big positions should be, as much as anything else. Our average holding period for positions has been historically, over a year. Probably, we're not playing for a missed quarter, by and large. Usually there's something just fundamentally wrong with the business or the business model, or the macro environment is just so daunting. On the other hand, if a stock sells off dramatically on something that we think is not important, which happens from time to time, we would cover some or all the position looking to re-enter. If we think the market has given us a gift for arguably the wrong reasons. And we try to be as flexible as we can without hard and fast rules. But it just depends. I mean, if it looks like the position might be dead money for a while, then it also depends on what else we have in the portfolio, or what's in the on-deck circle. What are the other possible competitors for our capital? Clearly, we would probably both agree the fundamental short side is pretty research intensive. The good news at our shop, we not only have a good team, my partner Chuck Hobbs and I are also analysts by training. So we do a lot of the primary work as well as the maintenance work ourselves on top of the team. It helps when the portfolio managers are involved in the process, which is unlike a lot of long-short hedge funds, where the portfolio manager entertains ideas from the more junior staff. And I've always kind of wondered about that. I think, you abrogate one of the most important parts of the process, idea generation, to sometimes, your most inexperienced, albeit well-meaning and well-educated, staff. That, in our process, works as much the other way around, if not much more so, where the partners are generating a fair amount of the ideas, and then they go to the research team for processing. But it is a more research intensive. Look, you're not getting any help from the street by and large, as you know, or management. You've got to do your own work, and often you come to a diametrically opposed point of view because you see something that just other people are missing. It depends on the market. Right now, almost everything we look at looks like a screaming short. but but in a more normal market, 10 or 20%, that's first going past my filter or his filter. Again, one of the advantages of that kind of top-down, top-heavy approach is that because of experience and pattern recognition, understanding volatility and what your risks might be outside of the research process, we can discard a lot of things and not waste the time of our team. Stuff we know that we'll never get in the portfolio, we're not going to waste our time looking at. Like anything, I mean, you look at lots of things and you have an idea, and then when you get into it, you realize, well, the market's pretty efficient. This thing is probably priced appropriately within some band. And then you get the outliers. You get markets like now where you can't make sense of almost anything you look at because things are just so stretched. People are chasing ridiculous business models. Companies are unit growth unprofitable and are growing as fast as they can because they've sold themselves as some sort of TAM story. I mean, I could go on and on and on.